demand for U.S. goods and services. But economists say the bigger concern is the global nature of the banking system.
The financial sector all around the world, but not less in the United States, depends in part on what the Europeans decide, because banks around the world hold government debt. And if government debt is no longer seen as ultimately very believable, very reliable, very trustworthy, then the holdings of those banks will be sold off, written down.
And that, in turn, could spark another financial crisis, similar to what happened in the U.S. in 2008. Unfortunately, even if this week's summit is a success, that doesn't necessarily mean it's full speed ahead for stocks.
We still have to see whether governments can actually implement plans, particularly the Italians and the Spanish government, can actually begin to move in a direction of getting their debt down and actually grow.
The biggest investor concern is the future of the European Union. Many strategists do not think the union will split apart in the next few months. But they say it's not out of the question the next few years if European leaders do not follow through with reforms. Erica Miller, Nightly Business Report, New York.
Some sharp words today from Ben Bernanke. The Federal Reserve Chairman responded to recent reports claiming the Fed directed over $7 trillion in secret loans to big banks during the financial crisis. In a letter to lawmakers, Bernanke said those reports contain, quote, a variety of egregious errors and mistakes. Now, last month, Bloomberg Markets magazine reported that banks reaped an estimated $13 billion in income by taking emergency loans from the central bank. Meanwhile, progress for creditors of Lehman Brothers, the investment bank whose collapse accelerated the financial crisis. A federal judge today signed off on Lehman's $66 billion plan to exit bankruptcy early next year and pay off its creditors. But it won't be the same Lehman. After the biggest bankruptcy in history, all that's left is a collection of assets like real estate, private equity, and banking investments. Unsecured creditors will get between 21 and 28 cents on the dollar for their investments, but shareholders will get nothing.
An update on the legislative response to that financial crisis. A cornerstone of the Dodd-Frank financial reform bill is tougher protections for consumers. But some of those protections have been on hold as the U.S. Senate spars over who will lead the Consumer Financial Protection Bureau. President Obama's nominee is former Ohio Attorney General Richard Cordray. A showdown vote on his nomination could come as soon as Thursday. As Darren Gertz reports for us tonight, the debate over leadership at the new agency comes as another watchdog comes under fire.
Republicans and Democrats traded jabs today over financial regulation. Democrats charged Republicans with blocking the confirmation of a new leader for the Consumer Financial Protection Bureau.
Without having a director, there are a whole host of rules that can't be written, which only perpetuates an uneven playing field where community banks and credit unions have to abide by regulations and non-bank lenders don't, which is not fair to consumers or the industry members who play by the rules.
A top Treasury official argued the problem goes beyond fairness, with financial markets still unsettled. Holding up the implementation of new regulations puts the economy at risk.
Without a director, the CFPB is unable to exercise its full authority. And as a result, our economy remains vulnerable to some of the same regulatory gaps that contributed to the financial crisis, and consumers continue to lack common sense protections.
Republicans like Alabama's Richard Shelby promised to hold up the vote, saying the agency needs to be accountable to a board, not a single director. Shelby also laid into another regulatory agency, the Commodity Futures Trading Commission. Shelby said he was bewildered the CFTC can't seem to figure out what went wrong at bankrupt broker MF Global. It collapsed in October as investments in European government bonds lost money.
According to the MF Global bankruptcy trustee, as much as $1.2 billion or more of customer funds are missing from the CFTC, are missing there. Where's the CFTC as a regulator? Where have you been there? And secondly, do you know where the money is?
CFTC Chairman Gary Gensler, who once worked for MF Global Chairman John Corzine, has recused himself from the case and referred questions to his colleague.
We're working closely with the forensics accountants that have been hired by the trustee to try to locate any missing customer funds. We continue to work through those issues, but we have not located all the funds that are missing, but we continue.
So the answer is you don't know where the money is.
That's right.
A Senate panel voted today to subpoena John Corzine, the former CEO of MF Global. Corzine has also been called to testify in the House on Thursday. No word yet whether Corzine plans to answer questions or will assert his Fifth Amendment rights. Darren Gersh, Nightly Business Report, Washington.
Tomorrow, Darren will talk with Senator Pat Roberts about the MF Global collapse on Halloween. Senator Roberts is the ranking member on the U.S. Senate Agriculture Committee.
Also in Washington, a debate is heating up over insider trading in Congress. The House Financial Services Committee heard testimony on a bill today that would stop lawmakers from trading based on non-public information they learn on Capitol Hill. The bill would also impose new disclosure requirements on lawmakers and their staff members. But the Securities and Exchange Commission Enforcement Director warns if lawmakers go too far with the new rules, it could have unintended consequences outside of Washington.
In light of existing insider trading legal precedent, any statutory changes in this area should be carefully calibrated to ensure that they do not narrow current law and thereby make it more difficult to bring future insider trading actions against individuals outside of Congress.
Right now, lawmakers are subject to the same rules on insider trading as the general public. Still ahead on the program, tonight's Word on the Street, technology. TheStreet.com's James Rogers weighs in. It's one of the largest settlements for investors in mortgage securities. Bank of America will pay more than $300 million to settle claims over mortgage securities sold by its Merrill Lynch unit. The class action lawsuit was led by a public employees pension fund in Mississippi. The fund claimed the investments were backed by poor quality mortgages written by subprime lenders, including Countrywide Financial and IndyMac. A federal judge has to approve the settlement. That may prove to be tricky since the settlement includes no admission of guilt by B of A.